Well, good afternoon, and welcome to another episode of Real Estate Talk with Lisa. I'm so glad you decided to tune in here on WBGR's Wellness Network, where we air every Thursday, 2:30 to 3:30. I want to acknowledge my guest here, Mr. Reginald Derrickson, man. Good to have you here. I tell you.
As always, thank you.
Reggie drops in. He's been on the show a couple of times as part of our Show Us the Money, Show Us the Cash segments, and we're gonna talk a little bit about how cash relates to you as we get into the show. You can find our show on the Wellness Network where we're airing now. If you're watching now, please hit the share, hit the invite. Just let somebody know, even if they can't watch it now, if you send them an invite, they might pick it up later. They might find some useful information. We're on Facebook in terms of our show page, Real Estate Talk with Lisa. We're also on YouTube, and you can find our archive shows on either place, YouTube, Real Estate Talk with Lisa. I am a realtor with Fairfax Realty out of the Greenbelt, Maryland office. And I'm also part of the senior team. We are a great team of realtors. We're 4 strong, and I'm telling you, we probably have maybe almost 40 years of experience now on the team combined with us, and we serve D.C., Virginia, and Maryland. So I got a great team: Paul, Sia, Sandra, and myself. And so we're looking to do great things in real estate. We had partnered with O-Line with Reggie for a home buyer seminar recently, and we're going to be scheduling another one coming up. I've been letting the people know to go to the Facebook page or email me directly, Lisa Jeffery 38 at gmail.com. You can email us at the senior team DMV at gmail.com, or you can just call or text me 301-542-5168 because we have a Grants 101 introduction that we're going to talk to you about, as well as other products that you can have in terms of purchasing your home. And then on the realtor side, we'll be talking to you about the steps that you'll be going through to home ownership, so that it won't be such a strange thing, and you'll have some expectations that will be really closely aligned with reality. Okay? So I just wanted to share that with you. Now, if any of you got our announcement, it said real estate before and after. But we're not talking about rehabs today, okay? We're talking about some of the things that you do before you purchase and some of the things that you do after you purchase. Now, our last show, we had Jackie Ward on. She called in, talked to us from Trammell Realty Group in D.C., and one of the things she was sharing was something she's focused on with her clients in D.C. is helping them get on a budget and have a financial diet. That's a key thing, right?
It's very key, very key. Again, we don't get into the budget part, but budgets play an important role because that helps to free up funds. It helps you to be focused on making sure you're able to save.
That's
one
right.
thing when you're saving, especially with your current housing expense, and now it's time to buy a house, well, your home may end up having a higher payment than what you're accustomed to now with your rent.
That's right.
So getting in with those budgets and saying, hey, I think I'd be able to save the difference between what I'm paying in rent now and what my new mortgage payment will be.
That's
so
right.
That's one thing you can do using budgets.
Exactly. And, I'm going to share a story. I told you all before, Reggie and I, we are birthday twins. We're born on the same day, same year. But there's a story that I have not shared with you. I know I've spoken to you guys before about having experienced periods of homelessness in my life. And there was a time when, I was trying to do everything right. I was looking for a job. I had been staying with friends, and the living situation changed, and so we had to get out, and I had no leverage. So I was staying with another friend, a set of friends, and God bless them. They were really great friends. And sometimes your friends have to let you know when it's time to go. You know what I'm saying? So, because otherwise you'll be there forever. I have one client, and we've been joking about the guest rooms. It's like when they're small in the houses, it's like, this is a good guest room because we don't want them to stay. We just want them to guest and go, right? Guest and go. But I'm thankful for them that they, continue to push me and say, okay, we know you haven't found anything, so you have to go. So I actually was in a shelter, and it may seem like, oh, that's devastating, and it was. It was a challenging situation, but God made it so. It was a shelter that I did not have to leave every day, so I was able to leave my belongings there, and while I was there, my pastor started a church-wide teaching on budgeting.
Awesome.
And right after I got there, as much as I've been looking for work before I got there, I think I was there on like I moved in on a Friday, and the temp agency let me know on Monday when I went to call them I had a job.
Awesome.
So I started working. I'm temping, and pastor's talking about this budget and you're saving for this and saving for that. I didn't even have rent. I'm at a shelter, but I did a spreadsheet and I started saving out of each paycheck a portion for my rent, because I had another friend. She was living at another shelter at House of Ruth, and we had decided we got ourselves together. We're going to get us a place. And so my daughter teases me now because I sometimes have those throwback Ziploc bag moments, because at the time I had a Ziploc bag and I had little itemized little sandwich bags in there because I didn't have an account at the time. And so I was putting, like, this is my snack money, this is my transportation money, this is what I'm going to have for groceries, and this is my rent money. And so I would buy what I was going to have for the snacks and things. At my office, I had a little drawer I could keep it in. And when the money was gone, guess what? The snacks was gone. So that made sure you didn't eat that whole bag of cookies like at one time. You kind of stretched that out. So that was, but it taught me. And when it was time for us to go, I could go in my bag, and I had the money for my deposit and my first month's rent. I had been able to accumulate that. Awesome. And I had the money for the utilities. We had made a guess at what our utilities would be, and so I had put that aside as well. And even once we moved in, I was able to govern what I got at the grocery store by what was in that section. And I moved from Ziploc bags, folks. I moved, okay? And I actually had a spreadsheet, but I knew in my total checking account what was in each of the categories.
Yes.
And I tell you, that was a memorable moment for me. But the thing about budgets is you got to stay vigilant.
Yes.
It's your budget is like a child. Okay, you start watching it, you find out that joker is like up on top of the cabinets, inside the refrigerator. You got bubbles from the bathtub all the way through the living room. You got crayon. So you got to keep your eye on your budget.
Absolutely.
And I can tell you all, I'm always reinventing, reimagining, redoing, because even with that experience, you can still slide back. So you can't live off your experiences.
Absolutely.
So when you're looking at a budget, one thing you want to do is you want to identify where you are. Jackie made a great point when she called in last week, because she was like, what I tell my folks to do is whatever you spend, write it down. And that's probably the first step you want to do when you're starting a budget, is take that first month to identify where you are financially. Where is your money going? What are you spending? Sometimes it's better. Sometimes people put you on some of the gurus will put you on like a cash only type plan, so that you have that, you feel the pain of spending your money. When you get that card out, you're like, swoop, and you're gone, right? You ever done that? You been to Best Buy or out with the other loan officers? Y'all going out for the big dinner? You're like, oh yeah, I got that. You ever done that?
I've done that, but again, it goes back, I guess, with budgeting. You have to pay yourself first. In other words,
that's right.
Put in those savings away.
That's right.
And then you have,
be consistent about it.
Exactly. Then you have your entertainment budget in line.
That's the thing. That's why you track what you're already doing, because budgeting does not have to be painful. It's not deprivation. It's management.
Exactly.
A lot of us, I mean, when I was growing up, when I first started working, none of us wanted to be in management. We always wanted to be the carefree, go-lucky employees. So we was watching the managers, and they had responsibility. And when you're young, you didn't want the responsibility, so you didn't want to be in management. But now, everybody needs to be in management. Everybody needs to be responsible. And so, when you are looking at your budget and your costs, if you know you like to indulge in entertainment, maybe you like to go to the movies, okay, well put that in there. But then you look for those, like get the loyalty card from the theater.
That's right.
So you can save money going to the movies.
The interesting part is, again, I'm going to talk about the debt ratio and housing ratio. That's off of your gross income. But like you mentioned a second ago, Lisa, budgeting is based on net.
But what you
actual
have left.
dollars.
Yes.
And as a percentage, the industry is pretty much saying, hey, based on your gross income, this is what you can afford, in terms of housing and or overall debt load. But at the same time, when you're looking at budgeting, yes, there's leftover,
That's right.
Leftover funds. So those are the dollars that's going to be left for those things such as utilities, all those other type of items, gas that's not part of the gross income calculation for the debt ratio and housing.
That's right. And that's why I have Reggie here today, because budgeting is a before. It's something that you're doing before you buy. Understanding your debt ratio, the DTI, because a lot of you, you're new home buyers, you're new to real estate. You hear your loan officer, because he may speed past it if he doesn't know, he's not cognizant of the fact that he needs to explain that to you. He may just run right over that like a speed bump, and so your DTI, and you're like, let's say, am I who?
Because a lot of times when I ask for
what that is.
Sure, a lot of times when I ask for income, individuals are giving their net pay, what they have, that's going into their account. But for calculating DTI, debt to income ratio, or housing ratio, we're going off of your gross annual income, and we convert that to a gross monthly total.
Okay.
And what's going on there is we're taking your gross monthly income and that income that's servicing your debts, like your car loans,
right,
your credit cards, student loan debt, those type of items.
Right.
Divided plus your housing. So if you're paying rent or if you already have a mortgage, that's added in there as well.
Okay.
Divided by your gross monthly income. And that gives a percentage.
Right.
And usually that percentage, and with most of the grant programs, usually have a 45% or less ratio.
45% or less.
Yes.
Okay.
Yeah. Ideally, that's where you want to be, 45% or less. That's going to qualify you for most of the program. Yes, there's other scenarios where it could go higher, depends upon compensating factors. And again, not everybody's going to purchase a home taking advantage of grant funds. But I just wanted to let everyone know that yes, there's other debt ratio calculations and numbers. Now there's some cases where the number goes in lower.
Right.
It's all based on the automated system. As you know, there's a lot of programs out there.
That's right.
And with those programs, every loan, every individual is different. Sometimes you can go with a higher debt load because there's other compensating factors.
Okay.
Such as length of time in employment.
Okay.
It can also be reserves. You have additional funds in the bank, or your TSP or 401k. So all that is part of the automated system that's going to give a findings,
Okay.
based on your specific situation. So it's not always a one
size fits all.
It's yes, we have these basic percentages and numbers that you should work, but ideally there are other situations, other scenarios where you can sometimes be higher and sometimes you're forced to be lower. Same thing with the housing ratios.
Okay.
That's the ratio that's really taking just your housing expense. So with your new mortgage, it's your principal and interest payment, your homeowner's insurance monthly, your property taxes monthly.
Yes.
If you're in a situation where there's going to be mortgage insurance, that monthly calculation, as well as sometimes there's homeowner's insurance. Not every home that's out there has homeowner's insurance, but we do make that part of the calculation. There's many cases where it's not part of the mortgage escrow mortgage payment.
HOA?
Yeah, HOA. I'm sorry, HOA. HOA. As well as condo fees.
Condos,
So
yes.
all those numbers are part of the housing ratios.
Okay.
And we take that total and divide it by your gross monthly income. Now, that percentage can vary. It has a pretty wide swing. Sometimes it could be 28%, 30%, or it could be higher. There's cases where if the compensating factors are there and the automated system allows it, it could be close to where the debt ratio is. So every individual is different. Again, it goes back to those compensating factors.
Right. And one thing I know that I have noted in some cases in working with clients is, we talk about credit a lot in terms of qualifying for a loan, and how good credit can get you a better interest rate, which has an effect on your payment because it costs you less to borrow the money.
Yes.
So you're paying less interest back, and because your payment is made of your principal, interest, property taxes, and homeowners insurance, if that interest amount is less, then your total payment is less. So, we talk about that. We talk about credit, but when we're looking at certain programs, you may have the credit score, and but you may have maybe a moderate income, and very little debt. But because when they're looking at the ratios, your ratios still may be a little high for some programs, but
Correct.
qualify you for others. So you may be looking at a program and say, hey, I think they're offering this program. I got good credit score. I've got this going on. Do I qualify? I know some of my clients have run into that. Have you experienced that with?
Yes, it comes down to affordability. Now,
Yes,
the interesting
that's right.
part is, yes, credit is always a part of this whole equation because that's
right.
where the payments are coming from. From your credit report, we're verifying that information. But yes, affordability is key, and there's ways to, like you said, increase your affordability. And one is, like you said, Lisa, is try to maximize and look at the lowest interest rate possible.
That's
because
right.
of course, the lower the interest rate, the lower the principal and interest payment. The other thing is you can plan ahead. Plan ahead by,
That's right.
communicating with a, mortgage specialist, loan officer, someone similar to myself, and guess what? Now we can kind of say, hey, look, let's make sure your goals and your affordability, based on how we calculate it, is in line. Because
Right.
if you're thinking you're looking for something higher, well, you may have to plan on paying off some debts before we submit the loan application.
That's
okay,
right.
so
Plan on a raise or paying off some debts.
exactly.
Yes.
So that's what we call planning ahead to increase your affordability, because now there may be a few things. You may be able to pay off a few credit cards in advance. And again, let us calculate it for you, because sometimes there could be a debt that you're looking to pay that actually you can get more out of paying off something else. Because sometimes
Correct.
installment debts, if it's 10 months or less, we don't have to count it in the calculation. Now you're going off paying that off, and guess what? That's money you could have been using for closing, being in the house, or hey, when you're in the house, I'm sure there's a few things you may want to add in there.
That's right.
So
That's a key thing, and that's one thing that we always stress when we do the show us the cash piece, and it's something that I communicate with my clients as well. Sometimes as a realtor, we may have a client that's already been qualified,
yes,
and so they've already selected their lender and had that conversation, and we start from the point of, okay, let's go look at houses. Other times, from like our home buyers workshops and just talking in the grocery store, we may end up with a client that wants to purchase but has not met with a lender. And I always encourage that individual to meet with the lender first, because that's the best way to assess where you are.
get your game plan in place first.
That's right.
You may have to think before you buy that new car. You got
Yes.
to choose. Do I want to buy the new car,
That's
or do I
right.
want to get in my new home?
That's right, because you can always get the car later. And you mentioned that. I had one of our viewers
Yes.
spoke with me just about a week or so ago and said, I've been watching the show, and I was about to pay off my car, and I was thinking about maybe another vehicle, but then I was like, you know what? I'm watching the show. I think I want to go for the property first because now
Absolutely.
my car is paid off. I don't have that debt. That puts me in a better position. So why assume more debt?
Absolutely. And I did a couple little calculations just to give you a scenario.
You guys got homework.
Absolutely.
You know I'm taking notes, right? With my big John Sharpies. You guys got homework. Okay, come on.
Oh, yeah. So you take, let's use an example. I'm going to use two income examples.
Okay.
I'm going to use $90,000 gross income, annual income, and I'm going to use $60,000 gross annual income. So if that's your gross annual income, we'll divide that by 12, and that $90,000 is converted to $7,500 a month. So that's your gross monthly income. Okay. Now you want to take a look at your car loans, your credit cards, your student loans, add those items together. Let's just say that total is $1,275. That's the minimum monthly payment. Again, we're going off of the minimum monthly payment.
Okay.
And let's say currently you're paying, let's say $1,600 a month for rent. Okay, but before I add that and total that, we're going off of what your ratio is going to be after you getting your home. Okay. So you may be paying $1,600 a month for rent now, but now when you buy your house, after we calculate your principal and interest payment based on the purchase price and your interest rate and everything, then we're going to add your taxes, insurance, and if there's any HOA fees, all those numbers in your housing. Let's say it comes up to $2,100. Okay. So now the $1,275 plus the $2,100 for the new house that you're looking to be qualified for, and that's why you need to contact someone like myself,
that's right,
mortgage professional, so we can calculate, based on the type of home that Lisa and realtors are saying, hey, this is what you're interested in, this is where your affordability is. Now that's $3,375, $3,375. We take that and divide it by that $7,500 gross monthly income based on the $90,000 calculation, and that percentage is 45%. So that means you cannot exceed 45%. For, like I mentioned, a lot of the grant programs, they want you to be 45% or less. But again, as I mentioned, there's certain loan programs, if you're not trying to take advantage of all the grant funds, that can also work for you, that's higher than 45%. Now I'm going to take the next number, which is the housing payment, of the new home of $2,100. Now I'm going to divide that by $7,500. Okay, that same gross monthly income for the $90,000 income earner. Now that happens to be 28%. 2,100 divided by 75. So there's two numbers. There's a 48% and a 45%. So those are the ratios. Sometimes they call it your front ratio, which is your housing, and your back ratio, which is your debt ratio. Some programs will don't really focus as much on the housing ratio if there's, as I mentioned earlier, compensating factors. But that's run through the automated system. And we'll have that information, after we run it through the desktop underwriting.
That's right. Okay.
So now, if you're not limited on the housing ratio, then one way to increase the monthly payment that you can go up to from an affordability standpoint is if some of those debts were paid down some. So you remember we said you're at $1,275.
That's right.
For car loans and credit cards. Let's say you was able to eliminate some of those payments by paying them off, or like I mentioned earlier, if you have a car loan or installment debt that's 10 months or less, there's many cases we don't have to include that into the ratios. So now let's say we subtract $275 from the car loan and your overall debts. So now we can add that to to 2,100. So now you, instead of your maximum housing ratio or mortgage payment being at 2,100, now it can be at $2,375. So now that could be the difference between, let's say, qualifying for a home that you really wanted. And I know the last segment that we had, I talked about how you could have three homes.
That's right.
All could be the same price, purchase price, but they all have different payments.
That's right.
And when you go out there and you're looking online, you're seeing homes, check it out for yourself. You'll see there's property taxes on house A that's, let's say, 280,000.
Yes.
Is different from house B at 280 and
That's
house
right.
C at 280.
That's correct.
Also,
That's correct.
one or two of them may have HOA fees.
That's
Now
correct.
that's added to that total. So now you can see we're planning ahead, getting an idea of what price range you think you should be in. Is it in line with your affordability? And
That's
if it
right.
isn't, plan ahead so we can help you to focus on these are the debts that you may have to target. Sometimes people just take money and just throw it at their debts.
That's right.
That's
right.
not always
or the bill that's screaming the loudest. You may have some challenges, and you say, "I really want to get rid of this one first. I'm going to get rid of that one first." But it helps to have, if you are paying off your debts with the goal of being debt free, but you also have that goal of purchasing a home. It really helps to speak with someone in the mortgage industry.
Absolutely.
To get an accurate, like you said, an accurate idea of the effectiveness of your paying off strategy.
Exactly. You're just not throwing money out there. You're targeting it so you can maximize your affordability.
That's right.
Same thing with the $60,000 scenario. Someone, wage earner, $60,000, divide that by 12, that's $5,000 gross monthly. So now gross monthly, if the limit is 45% in terms of your debt ratio, that means your total debts, car loans, credit cards, student loans, and the new house, the new mortgage payment cannot exceed $2,250. So that means that if you back out, let's say $750 worth of car loans and credit card debts, that means that in this example, $1,500 a month would be your housing, and that housing ratio would be $1,500 divided by 5,000, which is 60,000 divided by 12.
That's right.
12 months equally. That's a 30% housing ratio. So again, this is just giving you
a little bit higher.
Yes.
But it gives you an idea of what you need to do. And one of the factors that you taught that might make it a little easier for you with the ratios was, he mentioned reserves.
Yes.
And one of the points I wanted to make is that many of our gurus that are out there that talk to us about budgeting and about saving always talk to us about having that emergency fund, paying yourself first.
Yes.
So, and having a month's worth of your expenses, or 2 months worth of your expenses, 3 months worth of your expenses laid to the side. So even if you're getting a grant program, okay, and you qualify for that, so you're not necessarily having to dip into those funds to make your payment, sometimes having those present in your account can make the bank feel better. So now your savings are working for you as actual savings, but they're also working for you in terms of speaking of your saving habits and making you look more favorable as a risk option, I think, with the lender.
Exactly. And that's the whole key is the reserves, the compensating factors, helps to reduce the risk, because the banks want you to stay in the home. They want you to be able to, afford the payment. And that's the key is lowering the risk. The higher the risk, the least chances that you're going to be approved. The lower the risk, you're in good shape. Matter of fact, there's a particular Maryland grant program where the credit limit was 660. A lot of folks are like, wow, 660. In some cases that, knock a certain number of folks out of the, those programs. But they came back and said, hey, we'll go down to 640. And these are individuals with income up to 130, 154,000 in terms of household income. So there is grant money out there for those higher households. Exactly. But what they said was, okay, we'll allow 640. We'll go down to 640 if they have reserves, at least additional 2 months PITI reserves. And like you said, Lisa, whether you're saving it through your TSP, 401k, or in your savings or checking account, which is fine, you need those 2 months reserves. And that's after your portion of down payment or closing to get in the home.
That's right.
Oh,
That's
yes.
Right. That's right. Well, Reggie, I want to thank you.
Yes.
For coming by
It's been a
and
pleasure.
enlightening us. I hope you all were you writing it down? Okay, then you got to catch it on the replay, because this is something that's good for you to know before, so that you're not blindsided thinking, oh, but I thought this way. If you know this up front, it helps inform how you budget.
Absolutely.
It helps you think about those things, because knowledge is power. I think it's preparation plus education plus motivation equals home ownership. So during the time that you are getting ready to purchase your home, you're preparing and you're educating. So the preparing part is that budgeting piece.
Oh,
because, as much, and I'm telling you, I'm speaking for myself, as much as I would just like to say, okay, I budgeted today, are we there yet? No, we're really not there, because it's an overtime process that it takes you to get to your destination. So thank you so much for sharing that with us, coming out, making us do a little homework. But the homework is good for you to know where you need to go. We're going to cut to a commercial break now, and when we come back, I'm going to talk to you about a little bit more about the budgeting piece and some habits there, and a couple of the after pieces. And I got a public service announcement for you as well. So I look forward to seeing you back after the commercial.
Have you been looking for a new car? Godwin Motors has got you covered.
Awesome.
Check out their credit
always
sales
bring up
sales event. 100% credit approval regardless of credit, and emergency lenders on hand. Godwin Motors is located at 9071 Lanham Severn Road in Lanham, Maryland, 20706. Log on to their website at www.godwinmotorsonline.com or call 301-577-0400. That's 301-577-0400. That's Godwin Motors. And let them know you heard about them on WBGRsports.com.
Times are hard for many people in America today, but change can begin when you take action for yourself. Help is here. Log on to mymoneymyfreedom.com and get connected with a proven recession-proof company that has been helping people find financial freedom for nearly a decade. Whether you're looking to supplement or replace your income, they can help. They're a company with a AAA rating from the Better Business Bureau, and they do business in over 40 countries. Log on to mymoneymyfreedom.com. No selling soap, perfume, or makeup to your family and friends. No cold calling or knocking on doors for customers. They bring the customers right to you. The first step is yours. Take action now. Log on to mymoneymyfreedom.com. Their team of professionals are ready to help you succeed. Don't wait. Take action now. Start improving your financial future and put the passion back in your life. Log on to mymoneymyfreedom.com. That's mymoneymyfreedom.com. Take action now.
All right, so we're back. Hope you enjoyed our commercial break, and I hope that you enjoyed what Reggie shared with us about your debt-to-income ratio, also known as your DTI, and how that works and how it's calculated when the lender is looking to see how much money to loan you. Now, I want to share with you our public service announcement for today. The Gathering Men, Derek Johnson, who we mentioned on our last show, who had his very successful, I have pictures, I'll post them on the page, his Black History Month play on last Sunday. The Gathering of Men is the organization that he's part of, and their scripture is Proverbs 27:17. Iron sharpens iron. Okay, as a man sharpens iron, um, he sharpens the countenance of his friend. And they have meetings every month on the first Tuesday. So they'll be having their meeting this Tuesday, March 6th, and it's at 6:30 to 8:30. They're going to be at Greater Beulah Baptist Church in Capitol Heights. The address is 6056 Central Avenue. It's Capitol Heights, Maryland, 20743. And they have a special guest. The topic is going to be the joys and pains men experience after 50. You know, sometimes it's good to go to events that discuss topics that aren't common conversation, but everybody's dealing with it. Okay? And the special guest is holistic healer Akmal Muwakil, Dr. Akmal Muwakil. He's of the Energy Institute of the Healing Arts Foundation. Now, if you want to get more information about the event, there's free parking, so you don't have to worry about that. You can reach Derek Johnson, who's the facilitator, at 202 427 2414, or at Derek Johnson 63. That's DARICJOHNSON 63 at gmail.com. So that's one of our public service announcements. I think you'll see his information at the bottom of the screen. It probably was on earlier. It may still be on. But I also want to mention the Asala event. I know I posted a clip of me walking through the hallways during the luncheon part, just showing some of the scenery. It was a really great event. I was really glad that I volunteered. It was attended by at least 1,000 luncheon guests, in addition to great numbers of people that just came for the free event. The place was filled with authors. I was part of the outreach committee's volunteer section. We work with voter registration. We're actually able to get some folks registered for voting. I was with Miss Reba Burris Barnes, who's also with Reba Associates, our publicist for the show. Ms. Marvie Campbell and Dr. Arnita Fowler. We also share some time with author Dr. Juanita Patient Moss, whose father's coal artwork is in the African American History Museum in D.C. And she's also written several publications regarding the Civil War and soldiers. And her book that she was discussing there was about African Americans that served in white regiments during the Civil War, which for a long time was thought not to be the case. But I tell you, it was just a wonderful event, such a celebratory time, and I really, really enjoyed it. Looking forward to maybe participating again next year. So let's go back to some of the things that we talked about with Reggie, because as we're all kind of traveling, whether we're doing the investment piece or if we're doing the home ownership piece, we're all traveling on that road, and we're kind of, hopefully you're using the information we're providing on the show to make your map, because your map may have started out looking like this. This is kind of blank, right? And I'm hoping by now you're starting to put some X marks the spots on the different places on the map, like my credit score and my debt to income and my budget and my and including my savings and all of those kinds of things, that you're mapping out a path for yourself. And your path may not look like someone else's path. You may have a greater income than someone else. You may have a higher or lower debt to income ratio. You may have reserves. You may not have reserves. You may be looking to pick up a second job to create greater income to allow you to get to where you want to go. So we all have our individual circumstances, but hopefully as we're going along, you are making a map. And don't be afraid of the word budget. And I'm speaking to myself as well as you, because we always have to go back and revamp our budget. It's like a business plan, because it's your business plan. It's your financial um, roadmap. And so on it, as different things change, as you pay off some bills, you have to decide, okay, is more going to go into my savings, or what am I going to do with this extra money? I'm going to now target another bill to get rid of. What things can I do? Let's keep our eyes open for places where we can save. Sometimes it's a loyalty card. Sometimes it's coupons. Sometimes it's when we go to a particular event. Maybe if we go earlier in the day, we save some money. Just looking to take advantages of all the ways that we can save to get to where we want to go. Now, I had mentioned before that we were going to talk about what to do when you find yourself as a personal representative. And we actually had planned for that for this show, but we postponed the topic. We are going to pick it back up, I believe, in this month. So don't worry, we are going to come back to that. I want to talk just briefly before we leave you today about the after, because we spent a lot of time talking about the before. And I said we're not talking about rehabs, but we're talking about after. And there are two areas of after that people don't often think about. Number one is the will. Okay? But before we go to the will, let's go to life insurance. I want to talk to you for a minute about life insurance, because it's not something that people want to talk about, and I think it's because it deals with our mortality. We talk about car insurance, but we're hoping we're not in an accident, but we know that they do happen. May not happen to us, but they could happen, so we get insurance. We have medical insurance, hoping that we don't get deathly ill, but we know it could happen, so we go ahead and get it if we can. Okay? We look at long-term care insurance now because we know we're getting older. The baby boomers are getting older, so maybe we need long-term care insurance for grandma, auntie, uncle, dad. So we don't know if they're gonna need major care, but we're living longer now. They're pretty active right now, he goes out fishing. He may bowl or be in physical activity, but you just don't know. But you know what? Unless there's like I think Reggie said, compensating factors. Unless there's a compensating event, we are guaranteed to leave the planet. It's not even up for question. If we weren't going to leave the planet, then it'd be something going on. So we're pretty much guaranteed to leave the planet. Not guaranteed to have a car accident. Not guaranteed to have a medical emergency. Not guaranteed to have need long-term care. But we are guaranteed to leave the planet. And so we have to think about that, and think about that in the context of our real estate. So when we look at life insurance, is to protect your assets and to protect your family from your loss, from the financial burden of your loss. Now let's turn that just in the direction of real estate. You have budgeted, you have saved, you have denied all of your impulses so that you can get into this house. You and your spouse, partner, significant other, sibling, or just you by yourself. You could be a single parent, single person. Yeah. Now you're in the house. Now, what happens if something happens to you? What happens to all of the effort that you put into getting that house? You got the house now, but it took 2 incomes to get it. So now your family members are grieving your loss. Now, based on how you titled the property, if you're a husband or a wife, or you're in partnership with someone, you bought that house together, They may have rights to the rest of the property, but they also have rights to that mortgage. So what's going to happen to that mortgage? Just because you, as the spouse, get the house, you still have to make those payments. So we talked about responsibility earlier. Responsibility is a heavy thing. Freedom is a heavy thing. But if we're going to be homeowners, if we're going to build wealth, and we're going to build wealth that doesn't die with us, then we have to be, forward thinking and long sighted in terms of how we're going to live our lives and how we're going to plan. And most of what we're experiencing now is what we planned for yesterday or failed to plan for. Trust me, I've been a victim of my own poor planning many a time. So I'm not accepting myself from the conversation. So you want to look at, especially after you have your house, if you already have life insurance, that's great. You're ahead of the game. But now make sure that you have enough coverage so that when you're gone, the only thing that your family has to worry about is the loss of you and not the loss of the family home. And I think that's something that we have to be cognizant of. Okay? The other piece for the after is the will. Sometimes we create a lot of confusion because we just didn't tell anybody what we wanted to happen. And we can do a lot and save our families a lot of having to go through the courts or the government ending up with the property by properly getting ourselves a will. It's not an exorbitant cost. I have a link I'll share with anyone that wants information about how to do that very economic fashion and protect your family. But that is also something that we have to be mindful of after, that we make sure. I'm focused on the property aspect because there's a real estate talk with Lisa. But there are other assets that you would look at that you can address in your will. But if you have property in your family, you want to make sure that you have the proper after death vehicle, trust, living trust, will. And I'm saying these terms not because I'm a lawyer, not because I know every iota about what they mean, but I know they deal with the subject that I'm addressing. So those are some of your afters. So when you're doing your budget, you're doing a financial budget, but you also have a checklist of tasks that you need to include when you are looking at your planning after you have your property, so that you can secure that property for your children, for your family, so that once it's in your family, it never has to leave your family. Okay? That it can be passed on, it can be enjoyed, it can be lived in. Okay? So we have to be managers of that. We have to have a long view of what we want for our families and what we want for ourselves, right? Okay, so I had a couple of tips. I'm going to take a look now and see if I can pull them up. I had put them together for you guys from some things that I had looked at in preparation for this show. So one of the things is, they were talking about when you're talking about putting your budget together, overspending can break your budget, and you have to be aware of what the triggers are for you and plan accordingly. If you like to go to Starbucks, you could invest in your own coffee machine, but maybe you just like the atmosphere of going there. Then you budget a certain amount and you get your Starbucks card and that's it. Your card's empty, it's over. Because some overspending you can recover from quickly, but others will put you in a position of a debt situation that it may take you years to overcome. And you don't want that. Not where you're going, because you're going forward. You're going in the direction of personal wealth building. you're going to your dream home. You're going to that second piece of property like Sherman was talking about that you're then going to use to create, if not a business for yourself, maybe a business for your son or your daughter, or you may have a sibling that has a great business idea and they're trying to get it off the ground, and maybe you decide you can use that piece of property to help them. There's so many ways that we can take advantage of what we have, collectively and individually, to get where we're going. Now, there were some tips here in how to save. So let me see. Oh, automation. That's one thing. You know, we always say out of sight, out of mind. So another way to help you with your savings goals, once you have them set, is to automate it. So maybe you have another account over here that's where you're going to save, and maybe you don't have a card for that account. No debit card. It's one of those you got to call them, you got to ask them to send you a check for the account. But when you get your paycheck, you have a certain amount that just goes over there and it sits and it waits. Okay? So that's another way to help you, encourage you to save. Okay? Now, let's see. What other nuggets do we have in here? You know, when Sir Charles, when we interviewed him, he talked about knowing what you want, making the choices about what you want. And so it wouldn't hurt you to start a financial vision board. And because you're looking to get real estate, at least most of you, I think you are, because you're watching the real estate show. Now, could just be watching out of curiosity, okay? But if that's your goal, then we need to have something in our home that represents what we're saving for. You know, if we want to drive through neighborhoods, that's good. Of the type of places where we'd like to live, but having a picture on our board that this is what we're saving for. This is why we're doing this. Really have things that that stimulate you in the direction of moving toward that goal. Some of you are visual, so the picture is perfect. Some of you like things you can put your hand on. I don't know. Maybe you just love hardwood floors, and you want a house with all hardwood floors. Maybe, you get like one little hardwood floor tile and put a little note on it that said, this is going to be in my house. You write on it with a Sharpie and say, for my home. And you think about it. You may still have the picture. You got that tile that said, yeah, you know what? I'm going to have a home. It's going to have these kind of floors in it. So then you have something to shoot for. It fuels your motivation in terms of what you want. Okay? When we had Stephen on, and Stephen's information is still available, Stephen Underwood, shout out to him because he spoke recently at the Black CEO event at the Westin Hotel at Dulles. George Frazier was there. Trevor Otts, if you know, sales and marketing, was there. Number of big names were there, and he was able to speak and share that event with them. So we're really, really proud of Stephen. But one of the things he talked about when he was here was the shopping portal that they have, so where you can save there. So I just, as we're going into March, March is known as the windy month. Matter of fact, we've got weather reports now for big winds tomorrow. We don't want the winds of irresponsibility and distraction to blow us off course. We are endeavoring to reach our goals, and we want to stay focused on them. We want to, tighten up, tie down anything that's loose. When they say the hurricane's coming, you see the people there hammering up the boards, man. They're securing the fragile areas of the house. The glass, the windows, and everything. They're tying down. They got porch furniture. They can't bring it in, man. They got it tied to maybe the support beam of the house, with some ropes so that it doesn't blow away. So this is a time, we're still in the early part of the year, for us to take a look at our finances. I'm going to be looking at mine too, okay? And we're going to look at those. We're going to take the information that we've had so far. We're going to revamp our budget. If we don't have a budget, we're going to start one. Because the some of the things we see in the news about people arguing about the budget. We want the country to balance the budget. We have to balance our budget, okay? We want to look at long-term asset protection. Now's the time. You may not have your house yet. You're like, well, I don't have a house yet. I don't really need to be worried about who's going to get my property because I don't have any property. But you don't have to wait until you get your property to learn about how to protect yourself and the various ways to transfer that property and transfer that wealth to the next generation, the next generations. Okay? So don't wait. Learn now. Well, I hope that you have found today's episode encouraging, enlightening, because our job here is to educate, empower, and motivate you to action. So I hope somebody goes out and goes to Home Depot or Lowe's and picks up a little piece of kitchen tile that they like to see, or a bathroom tile that they might like to see in the color that they like for their kitchen. Or you get out some of those magazines or go online and print out a picture and get your financial board together. I hope if I have homeowners that are watching that haven't properly protected themselves with a will, with life insurance for their property, because you may have insurance, but you need to make sure you have enough, and the right kind that's really going to serve you, that you re-examine that. Okay? And I hope you've learned a little bit more about how your loan is calculated and how to position yourself to get the best rate and have the best options that you possibly can. And make sure that you're doing your very best every day to have the very best, because the very best belongs to you. Before I sign off, I do want to thank my team. I want to thank Reba Burrs Barnes and Reba Associates. I tell you, Reba's on it. You want to promote something, you want to get the word out, you want to spread your message, I'm telling you, Reba's the person to talk to. I want to thank Nicole King, part of our team. She is our photographer and also our social media manager. And she is continuing to help us with the show to give as much access as possible, help us post the relevant information. I do intend to post some pieces, some links to what happens if you pass away in Virginia, D.C., or Maryland, and you do not have a will. The D.C., the district has a nice, I think it's like 14, 15 pages, little pamphlet that kind of goes through what happens if you're a personal representative. So I'll make sure that you have access to that as well. With respect to budgeting, I'll send you the links. I'll have the links posted for some of the finance pieces as well. And we'll have Reggie's contact information. He didn't give it before he left, but I'll have that posted for you. So if you want to have a consultation with him, you'll be able to do that. And remember, next week, I'll see you at the show.